Hey everyone, it's Ryan Dash here with the Vancouver Life Real Estate Group, and welcome back to this week's episode of the Vancouver Life Real Estate Podcast. We've got a special one where I've got Merete Lewis here from Toronto. She's a realtor out of Chestnut Peak Real Estate Brokerage out of Toronto to help bring some sort of sense of boots on the ground validation to some of the stats we're seeing coming out of Toronto. We're going to really discuss also what we've talked about over the past, 6 to 9 months here, how it's changed, where we were at the start of the year versus where we are today, and ultimately what has happened to the Vancouver and Toronto real estate markets. It seems like we're in hibernation. So we're going to dive into this and so much more. And Merete, welcome back to the show. It's been a while.
Yes, absolutely. Thanks so much, Ryan. Thank you for having me.
Yeah. So, kind of as discussed here, we're going to have a look at both marketplaces. And I before we get into that, I want to set the stage, and I want to go through some of the stats that people are reading, compare them a little bit to what's happening in Vancouver, and then I think we'll get into some of the stuff we discussed way back to see how that panned out, but also to find out if what we're reading about is actually true. So bear with me as I go through some of the Toronto stats overview here. I'll compare them a little bit to Vancouver, and then we'll get into it. So taking a look at this month in Toronto, we'll start with sales. So home sales in Toronto, this was an incredibly soft October with less than 5,000 sales. In fact, it's so soft, there's only been a handful of times that have been worse. November 08 and 09, so the financial global recession. We had March 2020, the pandemic, and then today. And this is the lowest sales month we've seen since 1995. And so while sales have slumped, and we'll talk about this a little bit with Merete, at times it still feels like it's like this big beach ball that's being held underwater because, immigration hasn't relented. We've still got high prices, we've got high rates, and it depends if we continue to see rising incomes. One of these things is going to fluctuate, and that ball will pop up from under the water, whether it's now or in 6 months. I think that's the question. As we look at new listings here, September surged 11.3% in new listings. In October, there was a 2.9% pullback. So that's kind of nice to see. We're starting to maybe find some equilibrium here in terms of new listings. That pullback was a month-over-month trend, though. However, when we look at historical trends, we are up 39% year over year. This is putting us in a fairly deep buyer's market. Even new rental listings have surged 22% year over year for the quarter, well above the 7.5% transactional rate that we're seeing in the rental market. So even with new listings stabilizing, inventory is the highest it's been since 2012. And we went from a decade low in inventory, and then we crossed a 6-month span, and now we're at a decade high of inventory. Just crazy. When we look at HPI in Toronto is down 1.7% month over month. That's a fairly significant decline for 1 month. In fact, it's the largest monthly decline since interest rates have surged last summer. For the investor listening to this, the average condo in Toronto is negative $1,350 per month. That's not a very enticing environment for investors to be in. And I think we'll touch on a little bit of this with Merete as she talks about more and more policies coming into place, which is going to make that even harder. As inventory climbs in the condo segment, weaker prices are probably imminent. Okay, so let's compare this a little bit to Vancouver because usually these markets trail one another. Toronto is usually the leader, and Vancouver tends to follow suit, 3 to 6 months behind it. So Vancouver sales, after falling 13% in September and October, November is trending down another 7%, bringing us down 19% over those 3 months. New listings are flat for now. They're unchanged month over month, but up 16% compared to this time last year. So sales are falling, with new listings coming up, giving the edge to buyers in our marketplace. And that's true. We just did a deal yesterday where original list price at the start of October was 1.9, and we just got it under contract for below 175. I can't tell you the exact number, but it's under that number. So significant price declines that we're seeing in favor of buyers and sellers wanting to get deals done. Sales to new listings are hovering at 40%, indicating we are in further price decline mode. Inventory, touching inventory here, counter-seasonal inventory has climbed in October in Vancouver for the first time in 20 years. While inventory continues to climb here, it's not at the alarming pace we see in Toronto. However, that could change. We'll see. Price points here. HPI down 0.7%, so not the 1.7% we're seeing in Toronto, but this is the third consecutive drop in a row. With that said, prices are still on average 5% higher than they were in Vancouver this time last year. Okay, holy, that's a lot of information. But with that being said, before I kind of get into the things we talked about, Merete, does what I just spoke to, all these stats, the headlines, what people are reading, it's usually latent information, right? So it's usually data being compiled over time. What's your sense of the marketplace right now? What are you seeing from a boots on the ground perspective in your world?
So the market has definitely slowed. There's no question there in terms of the number of transactions that I'm seeing. It's a much slower pace than it had previously been. The sentiment of buyers is that they don't have the same sense of urgency that they once did because there is greater inventory. And it does depend a little bit on the product you're looking for. If it's something that comes up quite often, then you are quite choosy. And I'm seeing the strategies that people are using change as well. So before it was always, here's a low list price, market it for a week, and then set an offer date. And so much more often now, we are seeing, here's my price, offers at any time, or if they're choosing to hold back on offers, they're only slightly underpricing. So you're not really seeing, 999 hoping for 1.5. You're seeing 999 hoping for 1.1 kind of thing. So you're closer because you can't rely on as many buyers to really create that lift that you once could. So I think it's just a matter of everyone kind of adjusting strategy and expectations in this market, but it's definitely slower. Like listings are just way down.
Yeah.
Or sales are way down. Sorry, sales are way down.
Yeah. Well, yeah. I mean, when you look, Vancouver, we had, I think October rounded out at 1,924 sales for kind of the month. And that's okay. It's similar to this time last year. But generally speaking, it's slow. And we're seeing it here too. We're not, we're not seeing a whole ton of listing strategies where we see whole offers being held. I think a lot of buyers, they don't have to compete right now. And so I think if a seller tries to set up for competition, buyers are just going to say, no, I'll come back next week. And, or I'll wait. The other thing that I think is really apparent, at least here in Vancouver, we've spoken to a lot of mortgage brokers, a lot of banks, and we're hearing a lot that mortgage rates are likely going to turn in 2024, going from rate holds to rate cuts. I've heard stories anywhere from 0.75 to 0.25 for next year. And I think as buyers realize that interest rate cuts are coming, why would they move now? It's sort of like they've been in a restricted credit environment for 20 months. There's maybe 4 or 5 months left of this. Maybe I'll just wait it out and then affordability will start to come down. However, there's a double-edged sword to that, as we know in these inventory markets. It only took 6 months in Toronto to go from inventory historic lows to inventory historic highs. So 6 months is a big time frame in real estate. I guess my question is, do you think you're going to start to see prices inch up with interest rates as they begin to cut, or are you going to see just a stabilizing in the marketplace? What do you think is going to happen there?
I think more stability, Ryan. I think that people have to adjust to these higher rates, and not just like higher rates for mortgages, but kind of for everything in life. Like the price of eggs and whatnot. Just
Oh
life
yeah.
is more expensive now. And I think people need to kind of assess their spending and see where they're at. But there's a lot of people who are waiting and ask me all the time, are we at the bottom? Are we at the bottom? Are we
Mm,
at the bottom? Look, I don't have a crystal ball. Things aren't great right now. Maybe there's still room to go down. That's fine. The issue is that if you're buying a home for the long term, if you miss the bottom and you're trying to buy on the way up when
mhm,
rates have come down, I think there's going to be a lot of buyers returning to the market, especially in the lower price points where it um, influences them even more as a percentage. And then have you kind of missed the boat? So you have to look at the whole big picture. And some
mhm,
people are saying, look, yeah, my rates are high. I'm going to take a shorter term mortgage right now, and it's going to be painful, but I'm going to buy really well. I'm going to buy at a price and with less competition, and I'm going to be able to put these conditions in. All of a sudden, I'm seeing conditions. I never
mhm.
saw conditions before. The
It's
only
changed a
conditions
lot.
I would see would be on status review, which would be reading the condo documents. And that's only if the agent didn't have those before the offer came in 5 minutes after it was listed. But financing, inspection, I would never see that. And I'm seeing a lot more, honestly, it's truly due diligence, and that's not necessarily a bad thing.
Mhm. No, it's not, especially for buyers entering more of a reasonable environment to buy in, where they can, buy a home and like they did in the good old days, where you could actually negotiate with the seller, right? We, I am seeing, albeit certainly there's more movement in things in our market and say the condo space versus say the single family space. Part of that is due because I think 50%, around 50% of people in Vancouver have a mortgage on their property, another 50% don't. So the 50% that don't are, and for most intents and purposes, they're going to wait this market out until there's a better time to sell. That's just a reality.
Mhm.
However, buyers who are sharp, who are going to take a 2 or 3 year financing position and then, look to refi 6 months before their term comes up here, I think there's a real good strategy there because buyers have to choose one of two different environments to buy in. One where interest rates are higher but prices are lower, which is the one I'd recommend because, you go to the other side of this, and you and I have both been in instances where we see, people spend two, three, four, sometimes more, hundreds of thousands of dollars over the list price. So which evil do you want? Right. And I think right now, if you can get financing and you can negotiate a lower price, that seems to be the playbook, I think, of smart investors and smart buyers today.
Yeah, I would
Would you?
agree. And the thing you mentioned evil, and the thing also with evil is your land transfer tax is based on your purchase price. And
Good point.
so that's a very significant factor in Toronto, where it's double what it is in Vancouver. And also because we have a municipal land transfer tax too, it's very expensive to do business here in that
So,
sense. But
Marita, give us a sense of that. Like, if it's $1 million property, what are we looking at in terms of land transfer tax?
yeah, so it is a sliding scale. So currently, that's what's really interesting is that the threshold that it stops at is $2 million, and so the municipal land transfer tax is 2.5% on $2 million plus the provincial land transfer tax. So you're
Oh my
paying double.
God.
However, beginning in January, any sale that closes in January, not the deal is done, it closes then. $3 million to 4 million is 3.5%. And then above 4 is 4.5, above 5 is 5.5, and so on until you reach $20 million and it's 7.5%. Now, okay, look, I don't have a ton of sympathy for the people paying $20 million for a home because they probably have that extra money. Um, but what's really interesting is that city council brought this in this fall. And so deals that had already been written before they brought it in, and specifically the high end condos where you bought it years ago. If you're
Yeah.
closing in 2024, that is a very significant
You're now
extra tax.
subject to that. Oh my
Now they just
God.
say sorry, then don't live in Toronto.
Well, but like, how, blows my mind. There's so much tax in this country. There's so much tax in real estate. Another tax is just like, there's got to be another solution. It can't just be more and more tax, because what is the hell are the government doing with all this money? Where does it go? I mean, I get everybody wants more rental stock, but I don't see a whole ton of investment from the city going into rental stock and stuff like this. Like, it's crazy what's going on with all this money. Where does it go?
I don't know. I guess it's a bit of a wait and see, but in the meantime, it's especially, you know, I think kind of the people in the lower price points who are feeling it too, even though it's $3 million and up, who's getting the bigger raise now, but it's just because you need to come up with that on top of your down payment. And
Yeah.
so you don't
Those are not
already have
things
it built up.
you can't write that into your mortgage either. I'm assuming
No.
that's something that you got
Yeah.
to do
Well,
with cash.
yeah. And so you have to have all of that up front. So it has to do with right now, like if you're trying to qualify for a mortgage, you have to look at your down payment. You have to, of course, like the debt to service ratio, all that stuff.
Mm-hmm.
But then it's also the tax and your stress test as well. It's really difficult. And so that's why, some people are just kind of sitting it out right now because it does make significant impact. I'm really seeing it kind of in the lower end. The higher end, just on that tax that I'm talking about.
Mm-hmm.
So the month of December is going to be a very big month for closings for my brokerage. My brokerage, we're more of kind of a boutique brokerage, I guess, and we're located on the border of Summerhill and Rosedale. So those are two very affluent neighborhoods. So we have the largest market share in Rosedale, for instance. And so it does make a material difference. People who were planning on transacting, a lot of them said, well, let's get it out this fall so that we could close in December so that the buyer doesn't have to pay the extra tax. Because even though the buyer pays it, it's kind of going to come out of the sale price, right? To be able to make that adjustment so quickly.
Wow. That's crazy. So are you seeing, if we break it into sort of asset class here, I mean, you're mentioning the lower sort of price points. Are you seeing panic selling in any kind of way at this point? I mean, it feels a little bit like panic listing, but the panic selling part I think is quite different. I mean, it's one thing to put your property on the market; it's another to take a really low number. And I think we're probably seeing at least a lot of the data that I mentioned early in the episode primarily has to deal with condos. I mean, they're the biggest influence, I think, especially in the downtown Toronto core. There's more units available. There's more transactions of that type of property than anything else. Is that the biggest is that where you're seeing the biggest movement in price and the biggest movement in listings? I think as, comparatively speaking to say row homes or duplexes or single family.
So I'm definitely seeing that, Ryan. But also, if you consider the housing stock in Toronto versus Vancouver, there's a lot more of that kind of stepping stone property of those kind of row homes and whatnot. So smaller homes, we're talking kind of like 15-foot frontage, semi-detached. So you're attached on one side, or a row home where you're attached on both sides. And the ones closest to the core, I find, are still holding up fairly well. But the further out you get, especially where the housing stock's kind of all the same, it was more like almost like planned communities in some ways when they were done, where if you've been in one, you've kind of know there's only a certain number of floor plans. I'm seeing the hit there for sure. And so as a percentage, it's quite a bit. So these were homes that were selling for like 1.5, and now they're more like 1.2. And so as a percentage, yeah, it is. Like, look, fully renovated homes, those are still the ones doing the best because the cost to renovate, if you have to take out a HELOC, your interest rate's really high. Yeah. But if there's any kind of hair on the property, that's where I'm seeing the greatest deals right now. And that's hurting a bit. And I'm seeing people sell for less than they paid 2 years ago. And you think, look, with your transaction costs for tax and your realtor and whatnot, they're underwater. So there's a reason why people are selling. I don't know if it's full panic selling. And then also the strategies that I'm seeing are different. So before, everyone would buy first because buying was so hard. And selling, it was like, there's your for sale sign, get it done in a week, you're good. And now it's the opposite. So you sell first, you know what your closing is, you try to get a long closing so that you have more time to buy, but you know exactly what you're playing with, and it
Hmm.
relieves that stress a bit. Um, so it's interesting to see how the pendulum's going to switch and how quickly or slowly some people are able to react.
Yeah, I think here too in Vancouver, when we look at single family homes in the immediate proximity within Greater Vancouver, we've seen some price fluctuations. We're definitely still seeing nice homes. They still sell quickly, and in some instances with a decent plot of land, you will still see competition for that kind of thing. Our inventory has spiked for sure, but it hasn't spiked in the same sort of way that it has in Toronto. And I think that's due in part to the fact that we take 4 times as long to build anything here than you guys do. So, there's a whole other podcast for that. But, with that said, as you go into the tertiary markets like, the Abbotsfords, the, Chilliwacks and things like that, we're starting to see way bigger price declines there in single family than we did comparatively speaking to condos or houses within the Vancouver core. I mean, I also say, the further you get from the watering hole, the more volatile your property can become, right? And
Mhm.
I think that was true, especially of vacation properties and things like that too. Let's shift gears a little bit because I know you've probably read, I know a lot of people have read or have heard rumors. Here we've got major developers that are really struggling. It's not just it's not just buyers or sellers or of resale properties or pre-sale properties. It's also the people building and developing them that are having significant issues, especially cash flow issues. There's reports here of, and I can't really name them all, but there's some reports here of people walking away from hundreds of thousands of dollars for deposits they put on condos, 4 years ago, because those are now coming to fruition. And when they bought them, 3 or 4 years ago, when interest rates were, damn near rock bottom, and now they're looking at interest rates that are 5-6%. They've got to qualify at 8%. And let's say the condo is $4 million here, which is the case in some of the Cole Harbour instances. People are just walking away from their deposits flat out, right? They're leaving 400 grand on the table, 500 grand on the table, because I also think those properties that were 4 million are now going to sell for 2.8. And so
Mhm.
what's a bigger loss, leaving your deposit on the table and then maybe coming back and buying it for 2.5 million
Mhm.
or, you know, taking on a property that's, you paid $4 million for it, that'll take 10 years to get there again is not a savvy move. So developers here are we've seen them full on cancel projects, some having extremely bad cash flow issues, selling sites. Core Mandel had 17 sites. They went bankrupt. We're hearing about some other groups here. And it's crazy. I mean, I know from what I've read in Toronto, I think the one was going through
Mhm.
something similar like that. Can you maybe give us maybe a sense of your experience with that? Cause I know you were there, I think on opening day, and
Yeah, it was
I'd love to
when they
hear
launched.
your take on it. Yeah.
Yeah, and it was just there's so much hype and everyone was in such a good mood. It was this iconic building that was supposed to be, on the corner of Bloor and Yonge. Like what an intersection that is, just kind of in some people's mind like the center of Canada in many ways. It's really the center of east and west. It divides the city. So with such an enormous building going up, that it was kind of iconic, and it's a true symbol when it was announced that they're having really serious troubles and they have receivership.
Mm.
But the cost of everything went up so quickly, and then just as I was saying, the people who bought those really expensive condos over $3 million now all of a sudden on top of everything you just said now are going to have to pay an extra tax because they bought this years ago. And if they're closing January 1st, 2024 or later, they're going to have an extra tax to pay.
Which is crazy because they're definitely closing later on that building. That thing's still under construction, right?
Under
And
construction, absolutely. And it's quite
it's,
unfair, but I don't make the rules.
yeah, it's It's bananas. But, I guess in some ways, prices definitely do need to moderate, or incomes need to fluctuate in order for all of this to kind of flush out, because it's difficult to make sense of it. I will say though, the one went into receivership, and then it was picked up by a separate developer. It didn't take a whole ton of time. And
Mhm.
so there are some developers out there who maybe didn't get super aggressive during the last couple of years, who maybe saw some of this coming. And maybe, I don't know if you've heard this or not too. This is very recent news. Only a couple of days ago, we heard that right down on Terminal and Main, very close to downtown Vancouver, a 1.2 acre site that McDonald's actually owns as their
Mm.
flagship store here
I
just
know it.
sold. Yeah,
Oh,
yeah, just sold. And in 2014, that property was valued, and this is a really good segue into talking about how, you mentioned stop trying to time the bottom of the market, but get into the market and hold it. In 2014, this site was assessed at 24.5 million. Last year, it was assessed at $73.4 million, right? That's
that's a
8
lot of
years.
burgers.
Yeah, it is. And now the sale price hasn't been released yet, but we do know a 20-story building is going in there, and McDonald's is going to have a brand new flagship store there. So not all developers are struggling. And when there's blood in the streets, usually that's when you start to see people who have been waiting for these opportunities come in,
Mhm.
much like,
Mhm.
the new developers who have taken over the One to arguably build one of Canada's most iconic buildings. So very
Mhm.
strange marketplace we find ourselves in. And I think I'll kind of begin to wrap this by saying, Charlie Munger and who's the other guy? Warren Buffett. They
Mhm.
often say when we enter a recession, which is where I think we are now,
Mhm.
whether we want to
Whether
admit
we
it or
want to
not.
admit it.
But uh, people often enter a recession owning real estate, and the real estate survives. But what doesn't survive is the owner. And usually on the other end of the recession is a different owner of that piece of real estate. And I think we're going to start to see some of that, especially as we start to go through the next couple of years where we see a ton of refinancing taking place. I mean, a lot of the global debt recycling is being refinanced right now. Over, I think, the next 2 years, we're going to see something in Canada like 100,000 mortgages a month getting renewed. $600 billion in the next 2 years is going to get renewed in Vancouver, or sorry, not Vancouver, across Canada. There's going to be opportunity for people who have been sitting on the sideline waiting there. Not everybody's going to be able to manage this. And I think the same would be true in Toronto. Would you agree?
I would agree. Yeah, I would. In our office for the short term, we say stay alive till 25 because we know it's going to be a bit slow. But then it's about taking advantage of that. And, what is your plan and who are your clients?
Yeah. It's funny because when we did this podcast back in, I think it was February of this year,
Mhm.
we talked about a group called the Oxford Economics Group, and
Mhm.
I'm sure you remember that initial report they put out, which was they were expecting to see prices, I think, down by 30% by the end of July 2023, which was an absurd and terrifying thing to put out for a lot of people.
Yeah.
Prices on average, they were about half that. And then they recovered, like I said, you know, here in Vancouver, prices are up 5% over this time last year. So, be very careful with making your decisions based on people who blanket the Canadian real estate market with these reports, because they're not often correct. What's interesting too is they've come out with another one, and they have said that, in 2024 prices will drop by another 10%, with the total correction coming to somewhere between 20 and 25%. So they revised it back up a little bit. They realized they were a little too strong. I don't necessarily agree with that. I think what we're going to see is a lot of people come back to the marketplace once we find stability. But here's another thing, and I just love to see what you think of this. Um, they also said that affordability will take until 2027 to come back, and that is only considering a 30% down payment scenario. And it'll take until 2035 until 20% down payments become affordable again. That much I can get on board with. What do you think of that?
Yeah, but I think that it's such an average. And I think, when you look at across Canada, it's so different in different markets as well, because,
Mm-hmm.
where are the highest income earners as well? Like that's going to have
Good
a
point.
different impact than
Yep.
in some other places too. So that's maybe where we're kind of seeing these swings. Um, I don't, yeah, the 30% seemed pretty ludicrous. I think stability is to come, and we're seeing a bit of that now already in Toronto, but
Mm-hmm.
for sure affordability is the biggest question mark right
Yeah.
now. And that kind of needs to, for, the majority of buyers, that needs to stabilize a bit.
Yeah, so I think, if we can reduce the restrictions around credit, that will allow some affordability to relax. People paying, instead of paying 6.5% on a mortgage, if we start to see a 0.75% drop by the end of next year, probably in 0.25 segments, I think we'll start to see the return of some affordability. But I do agree largely with what you just said, because Toronto, people in Vancouver don't make the same incomes as people in Toronto. That much is well known. And so again, it's a bit of a blanket statement, but affordability is real across the whole country here, even for people who do make a lot of money. So anyhow, with that being said, interesting take. I hope it gets a little bit better out in Toronto. And it does sound like, though, if you're a buyer, you need to be having some serious conversations with your agents out in Toronto right now, because there's some good opportunities depending on what you're after. And I would say the same is true here in Vancouver, right? However, like we talked about, which evil do you want? Do you want the evil of competing and paying hundreds of thousands of dollars over because our supply hasn't really inched up to a point where we're going to see lower prices stagnate for some time? I think this is going to be a bit of a blip. Or, do you deal with lower interest rates? You get a bit better affordability, or you're dealing with higher interest rates and you're able to negotiate your price down, and you save on things like property transfer tax, and apparently two forms of that in Toronto, which blows my mind. Anyhow, we'll leave that up to the audience to make up their mind with. Merete, if I'm looking for a property in Toronto, how do I get in touch with you? What's the easiest way for me to reach you?
Yeah, you could just go to my website, merete.ca, merete.ca. It's got all my contact info. Give me a call, give me a text, send me an email anytime.
Cool. We'll put some of that information on the episode down low. And again, Merete, thank you so much for coming on the pod, and look forward to another comparative update sometime in the new year.
Mm-hmm. Thank you so much, Ryan. Have a nice day.